internal reconstruction and external reconstruction. Now, yesterday we started with internal reconstruction. We started with internal reconstruction, where we said that you are going to reorganize your capital structure through the capital reduction scheme. You reorganize your capital structure through the capital reduction scheme. And we discussed this concept yesterday. We said that with the amount of capital written off, you are going to write it off through the capital reduction account. With the amount of assets written off, you write it off through the capital reduction account. With the amount of liabilities written off, you write it off through the capital reduction account. That is what we did even in the question of April 2023, question number 1. Now, for us to internalize this concept, I want us to look at another question, because I know reconstruction is a major topic and I don't want to overburden you with future revisions here and there. Let's look at another question. We are looking at the question of November 2020. I believe question number what? November 2020. Kindly open November 2020. Open with me November 2020. November 2020. Question number 4. Question number 4. I want us to look at another question quickly. Question number 4B. Another question quickly, so that when you revise, this concept can now flow. When you revise, it can flow very well. It can flow very well. November 2020, question number 4. In this question, it says, Dynamic Limited has been reporting losses for the past few years. The creditors and shareholders have come up with a capital reorganization plan aimed at putting the company back on the path of profitability. The following is the summarized statement of financial position of the company as at 30th June 2019. We have tangible asset, intangible asset there, inventory, accounts receivable, investment, market value, 896. Then we have capital and liabilities, capital, share capital, we have 240 million ordinary share capital of shillings 20 each, 6%, 128 million cumulative preference shares of shillings 20 each, revenue reserve, accumulated losses. Then we have 6% debentures, accounts payable, bank overdraft, debenture interest payable, accruals, then director's loan. The court approved the scheme of reorganization, and it was to take effect on 1st July 2019. Details of the approved scheme were as follows. Number 1, tangible asset comprised freehold property and land valued at shillings 2720 million and 320 million respectively, while the intangible assets comprised patents and goodwill valued at 976 million and shillings 896 million respectively. Now, when you read note number 1, examiner, when you take in the balance sheet, we have tangible assets of 3040. Kindly, I believe we are together in the balance sheet. Tangible assets, 3040. Now, and intangible assets, 1872 there in the balance sheet. Examiner is saying that that tangible asset comprised of 2720 million, and intangible asset and property plant, freehold property 2720 and plant of 320 million. When you add together, you get 3040. Then we have patents and goodwill, of which examiner is just telling us what constitutes the goodwill and patents. Then examiner tells us that patents and goodwill are to be written off. Therefore, we are going to write off patents. When we write off the asset, you debit the capital reduction account. Patents and goodwill are to be written off. An amount of 480 million is to be written off inventory, and shillings 374.4 million is to be provided for bad debts. The remaining freehold property is to be revalued at shillings 2480 million. The investment was sold at the prevailing market value. Therefore, we sold investment. We are going to see that effect. Number 2, the 6% preference dividends are 4 years in arrears. Remember yesterday when we are discussing about contingent liabilities, I mentioned something about dividend in arrears, scheme cost, penalties, and any other expense. I believe you can remember that in our notes. Therefore, examiner is saying the 6% preference dividend are 4 years in arrears, of which 3/4 are to be waived, and ordinary shares are to be allocated at par for the balance. Number 3, the 8% preference shares are to be written down to shillings 15 million, shillings 15 each, and the existing ordinary shares to shillings 4 each. All the ordinary shares are to be consolidated into shares of shillings 20 each. The rate of dividend on preference shares is to be increased to 10%. Number 4, there are capital commitments amounting to shillings 2.4 million, which are to be cancelled on payment of 3% of the contract price as penalty. Number 5, the 6% debenture holders are to have their interest paid in cash and to take over part of freehold property, book value 640 million, at a valuation of 768 million in part payment of their holding. The 6% debenture holders are also to provide additional cash of 832 million secured by floating charge on the company's asset at an interest rate of 12% per annum. Number 6, the directors were to accept settlement of their loans as to 90% thereof by allotment of ordinary shares at par, and to 5% in cash. The balance of 5% was to be waived. Then number 7, trade payables were to be paid shillings 0.4 in every shilling to maintain and obtain an extension of their credit period. Number 8, the bank has sanctioned an overdraft limit of 40 million to provide working capital required. The capital reduction account to record the scheme of capital reorganization, 8 marks. The statement of financial position of Dynamic Limited as at 1st July 2019, immediately after effecting the scheme of reorganization, 8 marks. Therefore, examiner in this question was wishing us success. Examiner was wishing us success because he wants us to prepare the capital reduction account. Therefore, let's prepare the capital reduction account here. Capital reduction account. Keep it 9 lines going down, 9 lines going down, 9 lines going down. Then you prepare ordinary share capital. Ordinary share capital. Ordinary share capital. Give it 6 lines going down. 6 lines going down. Give it 6 lines. Then we have bank account. We have bank account. Give it 5 lines. Give it 5 lines. Give it 5. Wherever examiner has asked you to prepare the capital reduction, ordinary share is very crucial because in most cases it is about ordinary share. Then bank account is also crucial because sometimes you are going to sell assets, you are going to write off capital. Therefore, you need also to have bank account. Maybe you are issuing capital, it will echo there when you issue capital. Therefore, if you are down, you say yes, kindly, so that we move together. You don't want to do it alone, we move together. Therefore, if you are down, you say yes. Just be gracious to Ngalimu, you say yes, if you are down. Thank you very much. Waziri, thank you very much. Ruth. Therefore, we can move together. Now, we are going together note per note. Now, note number 1. Examiner says in note number 1 that tangible asset comprised freehold property and land value 2720 million and 320 million respectively, while the intangible asset comprised patents and goodwill valued at 976 million and 896 million respectively. Patents and goodwill are to be written off. Now, we are going to write off patents. When you write off an asset, you debit capital reduction, you credit asset. Therefore, I will say here patents. I believe we are moving together. Patents and goodwill. We are to write them off. Patents, examiner told us that it is patents 976. Then goodwill is 896. We have written them off. Those assets, we have written them off. Patents and goodwill, we have written them off. Then the examiner says, sorry, let me mute you all. I can hear background noise. Examiner again says, shillings 480 million is to be written off in inventory. Inventory, we are going to write it off in inventory 480. You write it off against capital reduction, which means when I check in the balance sheet, inventory is 2720. I'm subtracting 480. I'm writing it off 480. Therefore, whatever will remain is what will be my inventory in the balance sheet. But for now, we are writing off 480. Therefore, you write it off against the capital reduction account. Then examiner continues to say, shillings 374 million is to be provided for bad debts. We are providing for bad debts. Bad debts is provided for on a receivable. Bad debts is provided for on a receivable. I provide for bad debts on receivable. Therefore, my receivable will reduce by 374 million. Therefore, on my capital deduction, I say receivable. On my capital deduction, 374.4 there. On my capital reduction, I debit capital reduction with that amount. Then examiner continues to say the remaining freehold property is to be revalued at shillings 2480 million. Now, when you read note number 5, when you go to note number 5, we reduced freehold amount of 640. Amount of 640, we reduced freehold. Therefore, if we reduce, we want to see that effect. Therefore, that one will come in when we go to note number 5, where we reduce our freehold. Because after reduction, again we revalued. Therefore, we shall go there, then we reduce that statement of freehold. Freehold is to be revalued, therefore that one we shall revisit when we go to note number 5. Then examiner continues to say the investment was sold at their prevailing market price. Now let's sell the investment. Kindly, let's together sell the investment. When you check the investment in the balance sheet, investment, I have my investment account. Investment account, balance brought down. From the balance sheet is 352. Those who are joining, we are doing the question of November 2020. Question number 4B, internal reconstruction, which is very crucial. Therefore, investment balance brought down is 352. Then examiner is telling us that we sold it at a market price. What is the market price? When you check investment in the balance sheet, market value was 896. Therefore, bank, we received 896. That is what we sold this investment. Therefore, when you sell an asset, you credit the asset, you debit bank. Therefore, in my bank account, I will say investment. You debit bank, I will say investment, 896. I received money from the sale of investment, 896. But now you can see investment has not balanced. The investment has not balanced. We have the gain because we sold at a price more. We have the gain. How much is the gain? How much is the gain? Mwalimu is getting, is it 544? 544. 544 there. You can confirm it, 544. That is the gain on sale of what? Investment, but I believe you are confirming. Therefore, with this gain on sale of investment, we debit investment account, I credit capital reduction, gain on investment, on sale of investment, 544, 544. I believe you are confirming so that we don't write wrong figures. Okay, that is note number one, although we shall revisit the part of revaluation of freehold. We go to note number two. The 6% preference dividend are 4 years in arrears, of which 3/4 are to be waived and ordinary shares to be allocated at par for the balance. Now here, examiner is saying we have dividend in arrears. Dividend in arrears. Now, the other day we mentioned something on dividend in arrears. Somebody asked about the preliminary expense on that. Therefore, this dividend in arrears, what examiner is saying is that it was 4 years in arrears. Therefore, I will take 6% times the preference share capital, which is 2560, 2560 times 4 years in arrears times 4. I want dividend in arrears. Times 4 there, times 4 there. Therefore, this one is 0.06 times 2560. I get each year is 153 times 4. It is coming to 614, 614.4. That is my total dividend in arrears. Therefore, I will create the dividend in arrears account. Dividend in arrears. Therefore, when it arises, we debit the capital reduction. Therefore, on my capital reduction, I say dividend in arrears, 614.4. I credit my dividend in arrears, I say capital reduction, 614.4. That's how you account for dividend when it has arisen, when it has come up. 614.4. Now, examiner is saying 3/4 is to be waived. 3/4 is to be waived. Therefore, how much is the 3/4? Times 3/4. 3/4 is to be waived. That is 460.8. 460.8. Therefore, this one we waive. Therefore, to waive means you are going to write it off. That is a liability. We are going to write off the liability. Therefore, I debit here, I say capital reduction for 60.4, or 4.8, sorry, 0.8. On my capital reduction, I say dividend. I'm writing off a liability for 60.8. I have waived 3/4. Then, examiner continues to say, the balance is to be paid by issue of ordinary shares at par. The balance, how much is the balance? The balance is now their quota. Therefore, it will be 3614.4 divided by 4. 153.6. Therefore, here, 153.6, I'm allocating ordinary shares. Therefore, I'm issuing ordinary shares. I debit this account. I say ordinary shares, 153.6. I credit my ordinary. So in our ordinary shares, let's bring down the balance. Balance brought down. From the balance sheet, it is 4,800. Balance brought down is 48. Now, out of that, we are issuing the ordinary shares only. Dividend 153.6 there, 153.6. I have paid the dividend in arrears by issuing what? Ordinary shares. Therefore, I debit dividend in arrears, I credit the ordinary shares. Then this account is closed now. We are done with the account of dividend because we have written off 3/4. Then the balance, we have issued ordinary shares. Now that account is closed, it will not appear anywhere. That is how you handle contingent liabilities. Now we move on. We move on to note number 3. The 6% preference shares are to be written down to shillings 15 each, and the existing ordinary shares to shillings 4 each. Now we are going to reduce our preference shares. Now, when you check in the balance sheet, we have 6% preference shares. I believe you are opening your balance sheet. 6% preference shares, 6% preference shares. When you check the par value is 20. When you check the par value is 20. Examiner is saying we are reducing it to shillings 15. We are reducing that par value to shillings 15, which means we are going to write off shillings 5 per share. Shillings 5 per share. How many is our preference shares? Total preference shares. Total preference shares is 128. Total preference shares is 128 times 5. That is times 5. Therefore, it will be 128 times 5, 640, equals to 640. 640. Therefore, that one is total loss. We are writing off. We are getting 128. 128, remember, we have 2560 divided by the par value of 20, which is 128 shares. 128 shares. 128 shares. Those, you take the number of shares and the loss per share, which is 640. With this one, we are going to debit the preference shareholder. Therefore, I'm going to create an extra account of preference share capital. I'm creating the extra account of preference share capital there. Small account of preference share capital. Preference share capital account. Balance brought down. Balance brought down 2560. Out of that 2560, we are writing off 640. Therefore, I debit this account and say capital reduction 640. Then I credit capital reduction, I say 6% preference. 6% preference is 640 there. I have written off preference shares. Then, when we come to ordinary shares, examiner is saying that ordinary shares is to be reduced to shillings from 20 to shillings 4. From shillings 20 to shillings 4. 20 to 4, which means we are writing off shillings 16 per share. We are writing off shillings 16 per share there. Now, how much is total loss? Total loss. How much is the total loss? Total loss equals to when you check, we have 240 times 16. 240 times 16. 240 times 16. 240 times 16. We are getting that 8 what? That 840. That 840, that is our loss, total loss to be written off. Therefore, that total loss, you debit ordinary share. I say capital reduction. That 840. Then I credit Capital reduction, I say ordinary share capital written off that 840. You debit the share capital, you credit the capital reduction. Then examiner is continuing to say all the ordinary shares are to be consolidated into shares of shillings 20 each. The rate of dividend on preference shares are to be increased. Now, listen very carefully. Now here we have remained with 240 times 4, which is it 960? That is the value of the shares we are remaining with. Remember, we have reduced our par value to shillings 4. Listen very carefully because I will not repeat this. We have reduced our shares to shillings 4. Now, the value is we have 240 shares of shillings 4. We are getting 960 as our total value, Examiner is saying we are going to consolidate again those shares to the shares of shillings 20 again. We are going to consolidate. Therefore, if we consolidate, it means examiner wants to know how many shares are we remaining with of shillings 20. How many shares are we remaining with? Therefore, when you divide by 20, we are remaining with 48 shares. From 240, we are remaining with 48 shares. Now, that 48 will only affect us. Listen very carefully this because I will not repeat. That 48 will only affect us if we are going to issue another shares. We are going to issue another shares. Like, for example, examiner subsequently may tell us that after the reduction and consolidation, we again issued shares. For every 5 shares, you get 4. I'm giving an example. If I'm again going to issue shares, for example, for every 4 shares, you get 4. Therefore, there, I will say, what about 48? How many shares do I get? I will not base on 240, I will base on the new shares, which is 48. But in this case, it is not affecting us in any way because the value will still remain 960. Therefore, that consolidation, as at now, it is not affecting us in any way. It can only affect you if the examiner is saying, after the reduction and consolidation, the company issued the rights issue. For every, for example, 5, you get 4, or for every 1, you get 3. That is when it will affect, because we not base on the 240 shares, you base on the 48 shares. Therefore, here it's not going to affect us. With the preference share, it is also not going to affect us. We are just increasing the preference dividend rate. Subsequently, now we shall be paying preference dividend based on the 10%, not 6%. But for now, it's not affecting us. It is now not affecting us in any way. That statement, you just ignore it. But if you are to issue shares, then that one will affect us, because when we issue shares, remember, when you are issuing shares, you base on how many shares do you have. For example, if I have 240, I will say, for every 5, you get 4. What about 240? But now, because of the consolidation, I have remained with 48 shares. Therefore, if I want to issue shares, I will base on the 48. Therefore, that is what it means there. Let's go to note number 4. Note number 4 says, there are some capital commitments amounting to 2.4 million, which are to be capitalized on payment of 300 of the contract price as penalty. Now here, we are going to pay the penalty because if we are not doing well, it means that at some point, there are some capital commitments that we cannot engage because at the first place, we don't have money. Therefore, here, we are going to pay the penalty. Penalty is part of the contingent liabilities. Listen very carefully. Penalty is part of the contingent liabilities. Therefore, how much is the penalty? How much is the penalty? How much is the penalty? It will be 400 times that 3.33%. How much is the penalty there? Help Mwalimu get the penalty. Just quickly help Mwalimu get the penalty there. Help Mwalimu get the penalty there. How much is the penalty? Okay, Mwalimu is getting the penalty as 8 million. As 8 million. Mwalimu is getting the penalty as 8 million. Therefore, here, this penalty is a contingent liability. Is a contingent liability. That penalty is a contingent liability. Therefore, you debit capital reduction, and you are going to pay it through bank. Therefore, I debit here, I say penalty 8. Then I credit the bank because we are going to pay it. Therefore, I say in the bank penalty, which is 8. You credit bank, you debit the capital reduction, you credit bank there. You credit bank there. Then we go to note number 5. We go to note number 5. Number 5 says, the 6% debenture holders were to have their interest paid in cash and to take over part of freehold property, book value 640 million and a valuation of 768 million in part payment of their holding. The 6% debenture holders are also to provide additional cash of 832 million secured by floating charge on the company's assets at an interest rate of 12% per annum. 12% per annum. At an interest rate of 12% per annum. 12% per annum. Now, here, when you check in the balance sheet, 6% loan, 6% debenture, 6% debenture from the balance sheet, it has 240, 400. That is the 6% debenture. That is the 6% debenture, 400, 400, 400, 400. Now, what examiner is saying, we are going to reduce this amount by giving them freehold property. Freehold. And we are going to give them freehold. In our books, we take 640. Freehold, we are going to give them freehold. From our books, listen very carefully, it's very tricky, that note is very tricky. We are going to give them freehold. How much is the value of freehold? We are going to give them is 640. The value of freehold is what? 640. But when we go to pay the loan, we remove it in our books. Listen very carefully. When we remove it from our books, we are removing it as 640. When we go to pay, we are going to take it there as 768. We reduce the loan by 768. Therefore, which means we are revaluing that freehold that we are giving the debenture holders. We are revaluing it. We are revaluing it. Therefore, how much is the loan that will remain? It is 2,400 minus 768. I'm getting 1632. 1632. That is the value of the loan that will remain. I believe up to there we are in agreement that our 6% debentures, we are going to reduce them by 2,400. Then, when we take to remove, we take our freehold, we take it as 614. When we go to pay them, it is going as 1632. It's going as 1632 there. It is going as 1632. Therefore, the loan that is remaining is 1632. So it's going as 768. Now, in our in our freehold, when you take our freehold in note number 1, when you take our freehold in note number 1, examiner said that freehold was 2720. My freehold was 2720. Was 2720. Out of 2720, I'm going to remove 640. I'm going to remove 640. Now 2720 minus 640, I'm getting 2080. 2080. That is the freehold that is remaining. That is the freehold that is remaining. That is the freehold that is remaining. Now, out of that freehold that is remaining, in note number 1, examiner said in note number 1, can you go and read note number 1? Madam is waiting, you read note number 1 so that we move together. You read note number 1 so that we move together. You read note number 1 so that we move together. In note number 1, examiner said that this freehold, after we have paid the loan, we are going to revalue it to 2480. We are going to revalue it to 2480. Therefore, there is a revaluation gain. There is a revaluation gain of how much? Of 400. There is a revaluation gain of 400. Revaluation gain of 400. Revaluation gain of 400. Revaluation gain of 400. Now, let's start accounting for this note. Let's start accounting for this note. Let's start accounting. Examiner said that the 6% debenture holders were to have their interest paid in cash. We are going to pay the debenture interest. This is our account for debenture interest. Interest account. Interest account. Balance brought down from the balance sheet, 144. Balance from the balance sheet is 144. Can you see 144 from the balance sheet? Yes. Can you see it? Yes. Now, this debenture interest, we are going to pay them with debit this we say bank, which is 144 there, 144 there. Then I credit the bank, I say debenture interest. 144 there, 144 there. I have paid the debenture interest. Therefore, this account, I'm done with it. I have done with that account now. I have paid the debenture interest. After I paid the debenture interest, now examiner said that we are going to reduce their loan. We are going to take our freehold of 640 to reduce the loan, and when it goes to reduce the loan, it is going at 768. There is a valuation gain. There is a valuation gain of 128. Valuation gain of 128. Valuation gain of 128. That valuation gain, we debit freehold, we credit capital reduction. Therefore, in the capital reduction, I say valuation of freehold. Valuation of freehold. Freehold 128. I have gained because remember this, I'm taking the asset at 640, but when I give you to reduce the loan, I'm giving you at 768. Literally, I'm giving at a profit. Therefore, I'm recognizing that profit through the capital reduction account. Then, also after I have reduced this freehold, then I'm remaining with 2080. Then examiners told us in note number 1 that we revalue this. Therefore, there is a revaluation gain on asset. When you gain on asset, you debit asset, you credit the capital reduction. You credit the capital reduction. Therefore, I say revaluation of freehold. Revaluation of freehold, which is 400. I have revalued the freehold by 400. I have revalued freehold by 400 there. I have revalued freehold by 400. Then in the same note number 5, examiner is saying the 6% debenture holders are to also to provide additional cash of 832. Now it means I'm going to have two loans here. These people, now I have 6% debenture. 6% debenture. After reduction of their loan, we remain with 1632. After reduction of their loan, we remain with 16 what? 32. Now they are saying these 6% debenture holders are again going to give us another debenture at the interest of 12%, which means they are giving us another loan of 832. Therefore, I will have two loans. I will have two loans in my balance sheet. The loan of 6% and the loan of 12%. Therefore, in my bank account, I'm going to receive money, 12% debentures in my bank account. I'm going to receive money, 832. I have received money from the 6% debenture, but at an interest rate of 12%. I have received money in my bank account. You debit bank, you credit the 12% debentures. You credit the 12% debentures that way. That is all about note number 5. We go to note number 6. It says the directors were to accept settlement of their loans as to 90% thereof by allotment of ordinary shares at par, and as to 5% in cash, the balance of 5% to be waived. Now we have loan from directors. 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 Loan from directors. Loan from directors. Balance brought down from the balance sheet. Balance brought down from the balance sheet. It is 640. 640. 640 from the balance sheet. What examiner is saying, this loan from directors, we are going to give them ordinary shares. 90%, we give them ordinary shares. Then that ordinary share, 90%, 0.9 times 640, I'm getting 576. That one we debit, loan from directors, we credit ordinary share capital because we are issuing capital. Therefore, I say here ordinary share capital, 576. I have issued, then in ordinary share capital, loan from directors, which is 576. Loan from directors, I have issued ordinary share capital, 90%. Then 5% will be paid cash. 5% will be paid cash. Therefore, 0.05 times 640, I'm getting 32. We say bank, we are going to pay them bank 32 through bank. Therefore, in my bank account, I say loan from directors, I have paid 32. I have paid 32. Then 5% is to be waived. To waive means you are going to write it off. Anything you write off, you do it through the capital reduction. Therefore, I say here capital reduction 32. Capital reduction 32. Then on the capital reduction, I say loan from directors, which is 32. I have waived that. You waive it off through the capital reduction, Therefore, this account is closed. We have completely paid it. Now we remove it in our books. We remove it from our books there. Then we go to the next note. It says, trade payables are to be paid shilling 0.4 in every shilling to maintain and obtain an extension of the credit period. Now, examiner is saying that we are going to pay trade payables 0.4 in every shillings times 1600. When you check their total payables is 1600. Therefore, how much is the 0.4 in every shillings? 0.4 times 1600. I'm getting 640. Therefore, when we pay 640, the balance, they will extend the credit what? Period. Therefore, out of 16 minus 640, 960. 960 will be in our balance sheet. Why? Because we have paid 640, then 960, they will extend the credit period. They tell us that pay later. Therefore, this one, 640, we debit payables. Listen very carefully. You debit payables, you credit bank. You credit bank. In our bank account, we say payables. In our bank account, we say payables, 640. We credit bank, we credit bank, we credit bank there. We credit bank, we credit bank, we credit bank there. We credit bank. We credit bank there. Because we are paid. Anything you are paying, you pay it through bank. If you are issuing shares, like we paid loan through issue of shares, you credit shares. But if you are paying in cash, you credit bank. That is not number 7. Number 8, the bank has sanctioned an overdraft limit of 40 million to provide for working capital. Now, the bank has just sanctioned us that we can take a loan of, we can probably take an overdraft. But the question is, have we taken? Of course, we have not taken. Therefore, it will not affect us because we have not taken. We have not taken. It will not affect us. That one will not affect us because we have not taken. Therefore, that one, it will not have any impact in our accounting. It will not have any impact in our accounting. Now, we are done with all the notes, Now, when we check in our question, in our balance sheet, there is accumulated loss. There is accumulated loss. And the examiner has not mentioned anywhere about the accumulated loss. Now, what do we do with the accumulated loss? We have the accumulated loss, but the examiner has not mentioned anything concerning accumulated loss. What do we do with it? What do we do with it? My good friend Ruth, what do we do with the accumulated loss? It's in the balance sheet, but the examiner is silent on it. Examiner is silent. What do we do with it? What do we do with the accumulated loss? Now, remember, the essence of doing reconstruction is to remove losses on the balance sheet. The main reason for us to do reconstruction is to remove losses on the balance sheet. Therefore, in this case, the accumulated loss, I'm going to write it off against capital reduction. You write it off against capital reduction. Therefore, on my capital reduction, I will say accumulated loss. I write it off. Remember yesterday in our journal entries, we mentioned it. Therefore, we have 26, 24. 26, 24. You debit capital reduction, you credit P&L. When you check in our journal entries for yesterday, you can see it. You can see it. You can see it. You can see it. Therefore, that is what the examiner wanted. The examiner wanted the capital reduction, but remember, it cannot be complete without these two accounts. Without these two accounts. Therefore, we are done with our capital reduction. Now we need to do the balance sheet. But before we do the balance sheet, we need to determine if there is capital reserve or goodwill. Capital reserve or goodwill on the capital reduction account. You determine if it is a capital reserve or goodwill. Then also in the ordinary share capital, you will see balance carried down. Balance carried down, how much are we taking to the balance sheet? Then also in the bank account, how much are we taking to, are we remaining with in the bank account? How much are we remaining with in the bank account? Therefore, as we have the break of 5 minutes, I believe we will take time to balance these accounts as we take a break of 5 minutes. When we come, we continue with now serious items there. We continue with serious items. Kindly do it faster as we have break of 5 minutes. Figure on the capital reduction, balancing figure there. On the ordinary, let Marine do on the ordinary. Ordinary balance carried down is 1689.6. What about the bank account? Thank you very much, Ruth. You say here there is no balance in figure. Thank you very much. Now, when we go to our bank account, there is bank overdraft in the balance sheet. There is bank overdraft in the balance sheet of 1248. Therefore, we can also pay the bank overdraft. We can pay the bank OD in our balance sheet because we have cash in the bank. We can pay the bank overdraft. Kindly pay the bank overdraft of 1248. 1248. Pay the bank overdraft of 1248 because we have money in the bank. There is no need of leaving it open. You pay it if you have money in the bank. Therefore, when we pay the bank overdraft, it will be 80 plus. I have 416 balance carried down. 416. I have an overdraft of 416 in my bank. In my bank, I have a debit balance. That's an overdraft of 416. Debit balance of 416. Debit balance of 416. After paying also the bank overdraft, because we have money in the bank, you need to pay the bank overdraft. Then we have the preference share capital. Preference share capital. Preference share capital. $19.20 balance carried down $19.20. That is what we got in our balance sheet. Therefore, we are done with this question. Now we do the balance sheet quickly so that we move on to other things. We do the balance sheet quickly. Now we have the balances here. We do the balance sheet. Quickly, let's run through the balance sheet. Let's run through the balance sheet quickly. Let's run through the balance sheet. We say dynamic limited. Dynamic limited, you say dynamic limited. Dynamic limited. Statement of financial position as at 31st, as at which date? 1st of July 2019, as at 1st of July, as at 1st July 2019. You start with non-current assets. Shillings in millions. Non-current asset, then we have shillings in millions. Dynamic limited statement of financial position as at 1st July 2019. In a balance sheet, you start with non-current assets, of which we have non-current asset of freehold property. It was revalued to 2480. In note number 1, that asset was revalued to 2480, therefore we report the fair value. You report the fair value. Then we have land. Land in note number 1, we have 320. When you read note number 1, examiner says that land is 320. And remember, we have not touched that asset. Therefore, it remains 320. It goes to the balance sheet as 320. Then there is nothing else. We go to current assets. Current assets here. I'm going to have inventory, which is 2720 minus 480. Remember, 480 was written off. Then receivable from the balance sheet, receivable is that 104 minus 374.4. Remember, receivable, what will happen to receivable? We provided for bad debts, 374.4 bad debts. There is nothing else. Our bank is an overdraft. Therefore, it will go to liabilities. Now you give me total assets. Then we go to capital and reserves. Capital and reserves. Under capital and reserves, we have ordinary share capital, of which we have 1689.6. 0.6, I'm getting it in my balance sheet here. Sorry, not in my balance sheet. In my ordinary share capital account, we have the balance carried down of 1689. Then we have 10% preference shares. It was 1920. 10% preference shares, 1920. 10% preference shares, 1920. Then we come to non-current liabilities. Non-current liabilities, we have 6% debenture, 1632. Remember, we repaid that loan, and it remains 1632 after payment. Then we have 12% debenture. It was 832. 832, we issued 8% debenture of 832 there, 8% debenture of 832. Then under current liabilities, payables. Payables, we have 1600 minus 640 that we paid. We remain with 960. We paid 640, 0.4 in every shilling. Then bank overdraft. Bank OD, bank overdraft, we have 416. 416 as our bank overdraft, 416 from our bank account. Then in the balance sheet, we have accruals. Accruals in the balance sheet of 320. 320, accruals in the balance sheet of 320. Accruals in the balance sheet of 320. And I believe those are the items that is affecting our balance sheet. Those are the items that is affecting our balance sheet. That will give me total equity and liabilities. Total equity and liabilities, so that we move to the next agenda. Total equity and liabilities, so that we move to the next agenda. I believe we are done with that question. Thank you very much for being alert on it. It is challenging, but we shall overcome. 7769.6. Thank you very much. I believe this one also is 7769.6. I believe it is the same. Then that marks the end of that question. Now, I believe when you are given any question of internal reconstruction, you can do it because of the knowledge you have now, because of the knowledge. Okay, now we have to move on something else called suggesting the scheme of internal reconstruction. Suggesting the scheme of internal reconstruction. Before we go to external reconstruction, let's do briefly something called suggesting the scheme of internal reconstruction. We do something small on what we call suggesting the scheme of internal reconstruction. 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 Now, when we talk of suggesting the scheme of internal reconstruction, you are now the expert. You are now the expert. You are the one who is recommending to the company how much of the capital to be written off, how much of the assets to be written off. What should we do in this company? Now you are the expert. Therefore, you are suggesting to the company what to do in reconstruction. We are calling it suggesting what? The scheme of internal reconstruction. We are calling it suggesting the scheme of what? Internal reconstruction. Therefore, you start and say, sometimes, you say sometimes, sometimes one may be required to suggest the scheme of internal reconstruction. Sometimes one may be required to suggest the scheme of internal reconstruction. Sometimes one may be required to suggest the scheme of internal reconstruction. The following steps will be followed. 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 Sometimes one may be required to suggest the scheme of internal reconstruction. The following steps will be followed. Number one, determination of total loss to be written off. Step number 1, you determine total loss to be written off. You determine total loss to be written off. You determine total loss to be written off. How do you determine losses? We say here, losses, then shillings. Losses, shillings. Where do we get losses? Decrease in asset. Decrease in asset. That is a loss. For example, my good friends, when you check in the book value, in the balance sheet, the asset is 2,000. In the fair value, the asset is 1,500. Therefore, this asset has decreased in value by 500. That is a loss to the company. Increase in asset, that is a loss. Increase in liabilities. Increase in liabilities. Increase in liabilities, that is a loss to the company. When liabilities increase, it is a loss to the company. Then, when you have accumulated losses, accumulated losses is part of the losses in the company. When you have dividend in arrears, like in our case, we had dividend in arrears of 614. That dividend in arrears is the loss in the company. If you have scheme costs, those are the expenses that are coming up. Therefore, there are losses to the company. There are losses to the company. You get the losses there like that. Then you come and subtract you less gains. You less gains. What are you gaining? Like in the question we have done, you saw in the freehold, we were gaining in freehold by revaluation. We gain by revaluation of freehold. Therefore, here we say, we have freehold there, we say increase in asset. Increase in asset, that is a gain. You less the gains because we want total loss. We want total loss. Therefore, increase in asset, you less. Decrease in liabilities. Decrease in liabilities. When liabilities reduce, those are gains, therefore you less. Decrease in liabilities, you less. Then if you have revaluation reserve, those are accumulated gains. Revaluation reserve, those are accumulated gains. Revaluation reserve, those are accumulated gains. Then you get total loss. Total loss there. After you get total loss, then that is the end of step number 1. Step number 2, determination of loss per share. Step number 2, you come to determine loss per share. You come to determine loss per share. How do you get loss per share? You take your total loss, you divide by number of ordinary shares. Then you get loss per share. You get loss per share. Like I'm referring to the question we just did. Listen very carefully. I'm referring to the question we just did. Examiner told us that ordinary shares is to be reduced from shillings 20 to shillings 4. Therefore, that how did he come up with that? This is what they did to come up with that. Remember, we were reducing from shillings 20 to shillings 4. Therefore, loss per share is shillings 16. How do we come up with shillings 16? It is not magical. It is not magical. This is what they did. You get losses, total losses, then you divide by the number of ordinary share, then you get the loss per share. The loss per share, which was shillings what? 16. That is step number 3. Loss per share. Then we come to step number 3. Step number 3. We come to step number 3. Step number 3 is called preparation of a cash distribution statement on assumption of liquidation. Step number 3, preparation of a cash distribution statement on assumption of liquidation. Preparation of a cash distribution statement on assumption of liquidation. Preparation of a cash distribution statement on assumption. Now, what is the purpose of this statement? I believe you are listening. What is the purpose of this statement? Remember, in the company, you are telling the shareholders that I want to write off my capital. Like, for example, here, you are telling me that you are writing off capital of shillings 16 per share. Then, as an investor in your company, I will be worried. For example, I gave you a loan of 5 billion. 5 billion is not little money. Then you come to tell me that I want to write off capital. No, I will be worried. I will be very much worried that my money will be lost. Therefore, what you are doing here, you are preparing a cash distribution statement to assure me as the creditor in your company that your money is there. That in the event I liquidate today, your money is there. In the event I do what my good friends, I liquidate. In the event I close the doors, your money will not be lost. Therefore, you prepare a cash distribution statement on assumption. It's just an assumption. It's not that we are writing, we are liquidating. It's just an assumption. In the case I liquidate today, will you be paid? Yes. Therefore, how do we prepare this? We say cash expected to be realized. Cash expected to be realized. Cash expected to be realized, then shillings in millions. Shillings. Cash expected to be realized there. Where are we realizing our cash? We take our assets at fair value. You take your assets at fair value. You take your assets at fair value. Therefore, here, I will say, for example, I have land and building. I have land and building. I have land and building. How much am I realizing in land and building? 20 billion. I have it there at fair value. Therefore, I'm assuring these people that money is there. Maybe, listen very carefully to this one. Maybe I promised, I took a loan and I secured this loan on land and building. Remember, I cannot sell land and building unless I pay that loan. Therefore, if I secured anything on land and building, I must less security. Less security. Maybe there is a loan we took and we kept this one as collateral. Therefore, we must subtract that. We have assured, for example, if it is a loan from the bank, we have assured this person that your money is there. As you can see, from London building, we can pay you the money, then we remain with the balance. I remain with the balance. Then, maybe I have motor vehicle. Motor vehicle. Motor vehicle, this is what I'm realizing. Maybe I have land and machinery. Land and machinery. This is what I'm realizing. I have inventory. This is what I'm realizing. I have receivable. This is what I'm realizing. I have bank balance. This is what I'm realizing. Then total cash realized. This is called total cash realized. That is the total cash we have. That is the total cash we have. Now, after I have this cash, then I come to distribute to my creditors, to capital providers, to assure them that in the event I liquidate today, your money is there. Your money is there. Are we getting the point there? We are taking all our assets that we have, including what we have in the bank. Then we assure the stakeholders that your money is there. Now, if you are distributing this money, listen very carefully. If you are distributing this money, you start with the most preferential creditors. You start with the most preferential creditors, like my good friend Waziri, who is the most preferential creditors, like KRA. KRA is the most preferential creditors. If you have not been paying tax, you have not been submitting tax, you cannot close the company unless you pay the taxes. Like the city council. If you have not been paying rents to the city council, those people are not good people. Like the NHIF, like the NCC. If you have not been submitting that money, remember, you will not liquidate until you take that money there. You will not liquidate the company until you pay. Therefore, you assure them. Therefore, let's assure our stakeholders that in the event we liquidate today, your money is there. Therefore, we start with less scheme cost. Scheme cost, this is the reconstruction expenses. Reconstruction expenses, I'm assuring the experts that your money is there. Then we come and less preferential creditors, like the KRA creditors. Like the KRA, I have assured them that your money is there. Then I come to less creditors secured on the floating charge, on the floating charge. Creditors secured on the floating charge. Now, what is the difference between fixed charge and floating charge? What is the difference, Ruth? Ruth, what is the difference between fixed charge and floating charge? Now, when we talk of fixed charge, this one is fixed on a specific asset. Like here on London building, there is something that is fixed there. That is a fixed charge. Something is fixed there. Something is fixed there. That is a fixed charge. But when we talk of floating charge is buffering on all assets. For example, I have all these assets. I take a loan, then I say I present these assets. Therefore, if I'm presenting all these assets, it's called floating charge. Therefore, the bank can come and take any. It can take motor vehicle, it can take inventory, it can take land and building, because the church is hovering, is floating on these assets. Therefore, that is the difference. Therefore, we come and less creditors secured on floating charge. Then we come and less unsecured creditors. Unsecured creditors like the payables. Unsecured creditors like the payables. Then we have here cash available to capital providers, to members, cash available to members. I have cash available to members, cash available to members there, cash available to members. Then out of this, I come to less preference dividends. I come to less preference dividends. I come to less preference share capital. I come to less preference share capital there. Then I remain with, after I subtract that, I remain with cash available to ordinary. Cash available to ordinary shareholders. Cash available to ordinary shareholders. Cash available to ordinary shareholders. Out of this, I come to less ordinary share capital. I come to less ordinary share capital. Then I get total loss. Total loss to be written off. I get total loss to be written off. I have assured my creditors there that your money is there. If there will be any loss, it is me, the last person to be paid, is the one that I will regard the loss. That is why you always see that the ordinary shareholders have regarded the loss, because they are the last people. They are the last people to get anything in the company. Therefore, they must suffer some loss because they were enjoying the profits when the company was doing well. They were enjoying the profits. They were enjoying their profits. Then after we have done this, we got the last step. Last step is recommendations. Last step is recommendations. Recommendations. Last step, step number 4. Step number 4 last is recommendations. Recommendations. Is step number 4. The last step is recommendations. We give recommendations on how we are going to handle the company, to pay the creditors and to do whatever. We give recommendations. You put a dash and say, make recommendation on how various providers of capital, make recommendation on how various providers of capital, make recommendation on how various providers of capital and creditors will be compensated. Make recommendation on how various providers of capital and creditors will be compensated. This may include make recommendations on how various providers of capital and creditors will be compensated. This may include number 1. Number one, you say, we are just giving recommendation on how we are going to compensate various providers of capital. Number 1, you say, converting preference dividend in arrears converting preference dividend in arrears, converting preference dividend in arrears, converting preference dividend in arrears for preference shareholders, converting preference dividend in arrears for preference shareholders into ordinary shares, 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 or settling them in cash if there is money, or settling them in cash if there is money, or settling them in cash if there is money. We are giving a recommendation there. Therefore, remember what I'm saying in recommendation number 1 is just an example of recommendation. Not that in every question that is recommendation. No, I'm just giving you the example on how to give recommendation. So that, remember, it will depend with how you have read the question. Recommendation will be based on how you have read the question. What are the factors that are in the question? Because we are assuming you are an expert in internal reconstruction. Now you are advising the company. Now, my first recommendation, I'm saying, for example, I have dividend in arrears. Remember, I don't want them to go to the balance sheet. What will I do? Like in the question we did, we had preference dividend in arrears. Then they recommended that we give them 90%, we give them ordinary shares. That is why I'm recommending, I'm giving an example of recommendation to say that converting preference dividend in arrears for preference shareholders into ordinary shares. Or you can settle it in cash if there is money. If there is money, pay it in cash. We on the balance sheet. Number 2, recommendation number 2, you can say, adjusting the asset to their fair values as follows. Adjusting the assets to their fair values as follows. Adjusting the assets to their fair values as follows. Adjusting the assets to their fair values as follows. Adjusting the assets to their fair values as follows. Now, remember in the company, you have analyzed what is the book value. Book value is what is the balance sheet. Book value of the assets. Then you have analyzed what is the fair value. Like, for example, you have motor vehicle. This motor vehicle in your balance sheet, is 100 million. But when you check on the fair value, is 80 million. Therefore, you recommend that you reduce the asset to their fair values as follows. I said, Waziri, that you can recommend and say, adjust the assets to their fair values as follows. Adjust the assets to their fair values as follows. I was explaining that, not saying, for example, in the balance sheet, motor vehicle is 100 million. Then when we check in the fair value, it is 80 million. Then you are going to adjust it to 80 million so that you write off the difference of 20, it's a loss. You write it off, but you are recommending that let's adjust the assets to their fair values as follows. Number 3, you say, writing off an amount of excess capital in the company. Writing off, write off the amount of excess capital in the company. Write off the amount of excess capital in the company. If we have analyzed the total losses, those are excess capital that the company does not require. Those total losses from what we have analyzed, total losses, that is the excess what? Excess capital. Therefore, we are saying, remove it in the balance sheet. Write it off. As we are saying, we are writing it off against capital reduction. Therefore, we are saying, write off the amounts of excess capital not required in the balance sheet. You write them off. You write them off. Then number 4, Number 4, you can say unnecessary fictitious assets to be written off. Unnecessary fictitious assets to be written off. Unnecessary fictitious asset to be written off. Unnecessary fictitious. Fictitious assets are assets like goodwill, like preliminary expenses, like patents. Those are fictitious assets. Patents. You write them off. If you are making losses, then there is no need of those assets being on the balance sheet. You write them off. Then we are saying unnecessary fictitious assets to be written off. Another recommendation may be, I'm just remember, it's not standard. I'm giving you just an example on how you give recommendations, Now, another recommendation may be accumulated losses to be written off against capital reduction. Accumulated loss to be written off against capital reduction. Accumulated loss to be written off against capital reduction. Therefore, remember the essence of doing reconstruction is to remove losses on the balance sheet. Therefore, that's why we are recommending if there is any losses on the balance sheet, write them off against capital reduction. Last recommendation, you can say revaluation reserve to be utilized for the purpose of capital reduction. Revaluation reserve to be utilized for the purpose of capital reduction. Revaluation reserve to be utilized for the purpose of capital reduction. Revaluation reserve to be utilized for the purpose of capital reduction. Those are some of the recommendations you are going to give. Some of the recommendations you are going to give. There we have 4 steps that we have mentioned. Step number 1, determination of total loss to be written off. Step number 2, determination of loss per share. Step number 3, preparation of a cash distribution statement on assumption of liquidation. Then step number 4, we are going to give making recommendations. And we have given you the example of recommendations you can make, but it depends with our question. If our question does not have revaluation gain, you cannot recommend revaluation because it's not there. For example, if there's no goodwill or there's no fictitious assets on the balance sheet, you cannot say that fictitious assets to be written off. Where are they coming from? Therefore, it will depend with question per question. That marks the end of our internal reconstruction. And for that matter, you will do the question of December 2023, question 5. December 2023, question number 5. December 2023, question number 5. Then we meet on Monday. We go straight to external reconstruction. Monday, we go to external reconstruction. We are done with internal reconstruction. You will attempt the question of December 2023 because it wanted suggesting the scheme of internal reconstruction. Therefore, bye-bye. Thank you for your time. Let's meet on Monday as we continue with these serious items.